Okay, imagine this. All your encrypted data bank details, messages, government secrets, suddenly cracked wide open by quantum computers. Sounds futuristic, maybe.
Yeah, but it's a real concern. They call it harvest now, decrypt later, steal it now, break it later.
And that's exactly the threat driving companies like Arqit Quantum, ticker ARQQ. They're right in this race for quantum-proof security.
Welcome to the deep dive. Today's a bit different. We got a whole stack of research from one of you, our listeners.
That's right. You asked us to look at Arqit Quantum, ARQQ, specifically through a value investing lens.
Which is fascinating, right? Can you really apply those traditional value ideas to something this cutting edge, this quantum tech?
It's a great question. Value investing usually focuses on, what's happening now, the fundamentals. Quantum tech, that's all about the future, potential, and often, speculation, kind of different worlds colliding.
You can see that clash just looking at the stock price data you sent. It's wild. Over the last year, ARQQ bounced between, $3.72 and $52.79.
Huge swings. And even this year, 2025, it hit nearly $33 in May, but now, early June, it's hovering around $23. That volatility just screams uncertainty, high stakes.
Absolutely. It tells you right away that market feelings, hopes for the future, seem way more important here than, say, steady profits. Which leads us back to the core question we want to tackle today.
Based only on this material you sent us, does Arqit, with all this potential and volatility, fit at all with conservative value investing?
We'll circle back to that, pull it all together at the end. What's the final verdict based on these sources?
Definitely stick around for that. And hey, speaking of getting analysis you care about, if you like this deep dive format, make sure you like and subscribe to the Stock Analytics AI YouTube channel.
Yeah, and did you know members, for just Euro $4.99 a month, can give us a ticker, and we'll prioritize it for a deep dive like this. Plus, you get analysis after earnings calls, too.
It's a great way to get insights faster on the stocks you're following. Okay, so let's unpack this Arqit stuff. Where do we start? The basics.
Sounds good. So Arqit Quantum Inc. They're based in the UK, went public on NASDAQ back in 2021.
And their game is quantum cybersecurity. Software, services.
Exactly. Creating encryption keys that are supposedly unbreakable, even by those future quantum computers we talked about.
So tackling that harvest now, decrypt later threat head on. The idea that your data could be grabbed today and just stored waiting for the tech to catch up and crack it.
Precisely. It's a serious potential issue. Arqit's main solution seems to be their platform, Quantum Cloud, specifically a system called Symmetric Key Agreement, or SKA platform.
SKA, okay. And how does that work, roughly?
Well, it can be a platform as a service or like a private setup. Uses small software agent on devices. The idea is these agents help devices create really strong, unique keys locally between themselves.
And a key point they seem to stress, based on the sources, is this no rip and replace idea.
Yeah, that's a big one. They claim their stuff integrates with existing IT systems. You don't have to tear everything out and start over.
Which, for big companies, is huge, right? Avoids massive disruption in cost.
Absolutely. That's a major selling point if it holds true in practice.
Yeah.
They also have another product, Network Secure. The sources mentioned it was picked up by a Tier 1 network operator recently.
Okay. And both SKA and Network Secure actually brought in some revenue in the first half of their fiscal 2025?
Some, yes.
Yeah.
We'll get to how much later, but they did contribute. Their tech is built around this symmetric key approach, and they're big on compliance, mentioning standards like NSA CSFC, RC 8784, ISO 27001, plus they're building up their patents.
So they're positioning themselves in this quantum security market, which the sources say is set to explode, like almost 50% growth per year.
Yeah.
To over $8 billion by 2029.
Yeah, massive projected growth. The drivers are pretty clear. More cyber threats, tons more data, demand for things like QKD, and that HNDL urgency. Arqit seems to be targeting telecom and defense mainly.
Okay, huge market, urgent problem. But here's the disconnect that jumped out from the sources. Their revenue in H1 FY 2025 was tiny. $67,000.
Yeah, 67,000. That number really stands out, doesn't it? It highlights this gap between the potential need and the current reality of sales.
So what does that suggest?
It suggests that while the threat is real, the broad commercial rollout of these advanced quantum security solutions is still, well, really early stage. Companies aren't writing big checks just yet. They're testing, evaluating.
Ah, okay. So long sales cycles, pilot programs, that kind of thing.
Exactly. And the sources back this up. They mentioned Arqit was doing demos and tests with 6 telecom operators and 17 other organizations in that same period. The big challenge for them is turning those tests into actual paying customers. soon.
And it's not like they're the only ones playing in the sandbox. The competition looks pretty stiff.
Oh, definitely.
Yep.
The sources list several key players. You've got Arqit Quantum doing QKD, physically setting quantum keys and random number generators. Isara, they focus on crypto agility, helping companies switch encryption methods. Then there's Sandbox AQ, spun out of Google, doing crypto inventory and migration. Crypt, using quantum entropy for keys. And PQ Shield, working on post-quantum crypto for hardware, software, cloud.
Mhm.
They're involved in the standards, too.
Wow, okay, so quite a few different angles on solving this. How does Arqit's SKA approach differentiate itself in that crowd, according to the material?
Well, they highlight their specific symmetric key tech, that lightweight software agent, the no rip and replace claim we mentioned, and being standards compliant. They also just bought some IP from Amplify Technologies in May 2025, presumably to strengthen their position.
So you've got physical key distribution, software libraries, migration tools, entropy stuff,
Yeah.
and Arqit's SKA trying to carve out its niche.
Right, lots of paths to the same goal, quantum-resistant security.
So for you listening, why dig into these product details and market dynamics?
Because you need to understand what Arqit actually offers and how it compares. Is
Right.
there a real sustainable business here? Can they win against these competitors in a market that's still forming? It's fundamental.
Okay, now, here's where it gets really interesting, especially thinking about investing. The people in charge.
Absolutely critical. Management is key, especially for a company like this early stage, facing big hurdles. And Arqit, they've had some major leadership changes lately.
Yeah, a new CEO, Andy Lever, came in September 2024, background in scaling software firms, and then a new CTO, Jonathan Goyendu, just arrived in April 2025. Deep cybersecurity experience. The previous CTO was a founder.
That's significant turnover at the top pretty quickly, often signals a shift in strategy. They also got new independent chairman Garth Ritchie in May 2025 and other independent directors.
Now, on the governance side, the sources are a bit thin on exact insider ownership levels, but here's something that really caught my eye. NASDAQ data apparently shows 0 open market buys and 0 open market sells by ARQQ insiders in the last 3 months. In the last 12 months, nothing.
Yeah, that lack of insider buying, particularly when the stock is dipped, is definitely, well, it's notable, isn't it?
It seems significant.
It does. Now, there could be reasons, blackout periods, personal finances, who knows? But from that classic value investing perspective, you want to see management showing conviction, right? Putting their own skin in the game. The absence of that, well, it raises questions about their view on the current valuation or the near-term outlook.
In their H1 2025 update, management did talk about the low revenue. They blamed a delayed big contract in Europe, Middle East, Africa region, and also a shift towards using channel partners, which affects timing.
Right. They said operating costs were around $2.4 million a month, which was apparently on budget, and staffing was even under budget.
Their message seems focused on that strategic shift, telecom, defense, and converting that pipeline. You know, those 6 telcos and 17 others they're testing with. The CEO apparently called their solution a leading cybersecurity antidote.
But that brings us back to that gap we mentioned earlier, and it's pretty stark here. You have management talking up progress, the pipeline, recognition.
While the numbers show $67K revenue and a $17.2 million pre-tax loss for the half year.
Exactly. The sources really hammer that point, the huge disconnect between the narrative and the financial reality. It just highlights the massive execution risk for this new leadership team. They absolutely have to turn those demos and tests into real money fast to bridge that gap.
So why focus so much on management when you're looking at a potential investment like this?
Because, honestly, in a situation like Arqit's high potential but tiny results, so far, management's ability to actually execute the plan, navigate all these challenges, and turn that potential into performance, well, it's pretty much everything.
And that lack of insider buying.
That's a piece of data you need to weigh. What does it suggest to you about their confidence? It's part of the puzzle.
Okay, let's brace ourselves. The numbers. Financial health? Or maybe the lack of it, based on these sources.
Yeah, this is where the traditional value investing approach really bumps up against Arqit's reality. Historically, minimal revenue, and it's been declining recently, only $241,000 over the last 12 months reported in the sources.
And the losses.
Substantial.
Yeah.
And growing. The sources noted the average quarterly loss jumped by almost 150% over the last 2 reported quarters. The most recent net loss was around $17.16 million.
Oh, okay, let's break down those H1 FY 2025 results again. Revenue, $67K down from $119K the year before. Gross profit, just 51K.
Right. But then you hit administrative expenses, which includes R&D and sales, nearly $18 million. That just blows everything up. Operating loss around $17.8 million, net loss around $17.17 million.
Those admin costs are just eating everything. What about the balance sheet as of March 31st, 2025?
Then $24.8 million in cash. Total assets were $30.2 million. Liabilities were pretty low, $4.9 million. So total equity shows as $25.3 million. But that equity is overshadowed by a huge accumulated deficit, over $305 million. That's all the losses piling up over time. Debt is low, though, only about $25 million.
And the cash flow, that really tells the story of the burn.
Absolutely. In H1 2025, they burned through $19.3 million just from operating activities. That's cash out the door to run the business.
So management talked about $2.4 million a month in costs, but the actual cash burn from operations was higher.
Yeah, closer to $3.21 million per month when you factor in working capital changes shown on the cash flow statement.
Yeah.
And how do they cover that? Mostly financing activities. They brought in $3.8 million, almost all of it, from selling shares through their at-the-market or ATM program.
Okay, so burn $19.3 million, bring in $3.8 million. Net result is they ended that 6-month period with $15.6 million less cash.
That's the bottom line. And it's critical. If you have $24.8 million left and you're burning around $3.2 million a month, well, do the math.
That's only about 7 or 8 months of runway, assuming nothing changes, no new revenue, no more financing.
Exactly, which is why they are so reliant on that ATM program. They're authorized to sell up to $75 million in stock that way. They used $4.3 million of it in H1 2025.
But constantly selling stock to stay afloat means dilution for existing shareholders, right?
What?
It's like a treadmill.
A dilution treadmill is a good way to put it. They need the cash, but getting it this way reduces the ownership stake for everyone already holding shares. It's a tough spot.
And valuation metrics, I'm guessing they don't look great from a value perspective?
No. The price-to-sales ratio, based on the sources, is astronomical. Something like 1,405 times trailing sales.
1405.
Yeah. The source compared it to Palantir, which trades around 95 per dollar of sales, Arqit. Around 1,293 per dollar of sales based on that TTM figure.
That just screams disconnect from reality.
From a value perspective, yes. It's a huge red flag. Valuation completely untethered from current performance. Things like PE, ROE, ROIC, meaningless. Deeply negative because of the losses. Debt to equity is low, but that's expected for a company funded like this.
So wrapping up the financials, what picture should you, the listener, be getting?
You should be seeing a company in a potentially exciting future market, but right now. Minimal sales, huge losses, high costs, burning cash rapidly, and facing a limited runway without constantly selling more stock.
And that cash burn and need for financing is crucial because
But it's about survival. How long can they last? And raising capital dilutes your potential ownership unless they can somehow massively boost revenue to justify it all. It's a major, major risk.
Okay. So that's the internal picture business management financials. What about the outside view? Market sentiment, risks.
Well, here's another interesting contrast. Wall Street analysts who cover Arqit, they seem surprisingly bullish given everything we just discussed.
Really?
Yeah, the consensus rating based on the sources is buy. Like 85% of the analysts covering it say buy.
And the price targets must reflect that optimism.
Oh, yeah. Average target is way up there, around $52 or $53. One source even mentioned a huge target hike, over 90% back in January 2025. These targets are miles above the current $23 share price.
So analysts are clearly looking way past the current numbers.
Totally. They're betting heavily on the future potential, the tech's promise, the market size, basically ignoring the current financial state. Short interest, relatively low, around 0.6 million shares, maybe 9% of the float. Days to cover is really low, like half a day to 1.5 days. Shorts could get out easily, and it's actually down from mid-2024 levels.
What about technical signals?
Yeah.
Charts and stuff?
Kind of mixed. One source apparently said sell, but NASDAQ Dorsey Wright gave it a high technical rating. That NASDAQ rating is probably just reflecting the recent price surge, though the stock was up over 44% in the month before June 5th.
Right. So here's that divergence again, starkly. Optimistic analysts, high targets, recent momentum, versus terrible fundamentals, sky-high valuation, cash burn.
Exactly. It strongly suggests the price is driven by speculation, by hope, by market buzz, not by the underlying business performance right now. And for a value investor, that's a flashing warning light.
So for you listening,
Yeah.
how do you weigh that? Analyst hype and stock charts versus the cold, hard financial facts and risks.
That's the fundamental question, isn't it? Especially here. Are you investing based on sentiment and a story about the future, or on tangible present value? They're very different bets.
Okay, let's quickly look at who actually owns the stock.
Institutional ownership is pretty low. Again, not surprising for a smaller, speculative tech name. About 3.47% held by institutions as of March 31st, 2025.
Who are the main holders mentioned?
Sources list names like UBS, Virtu Financial, SBI Securities, HRT Financial, Morgan Stanley. Interestingly, many seem to increase their positions in Q1 2025. Some started new ones, while Jane Street reduced theirs.
And let's just hammer this home one more time. Insider activity.
Still zero, according to that NASDAQ data and the sources. Zero open market buys. Zero sells by ARQ insiders in the last 3 or 12 months. The sources mention some Form 4 for an ARQ Inc., but that's a different company. So for ARQQ itself, nothing showing up on the open market.
What signal does that send, the lack of insider buying combined with low institutional holding for a stock like this?
Well, the lack of insider buying can be seen as a lack of strong belief from the people who should know most. Low institutional presence suggests many big conservative funds are maybe watching from the sidelines, thinking it's too early, too risky.
Although some big names are taking small stakes.
Right, which some might see as a positive sign. But overall, it doesn't scream widespread conviction from the professional or insider communities based on fundamentals.
Okay, reality check time. Let's consolidate the risks. What are the biggest hurdles Arqit needs to clear based on all this material?
They are significant. On the company's side, that huge reliance on just a few potential large contracts, like the EMEA one that got delayed. Massive execution risk for the new team. Can they actually close deals? Technology risk. Can they keep up in this fast-moving field? Financial viability risk, the burn rate, the losses, the path to profit looks very long and uncertain. And of course, dilution risk from needing that ATM funding.
What about industry-wide risks?
Intense competition, as we saw. Rapid tech changes and shifting standards in quantum security, those long sales cycles and just general hurdles getting companies to adopt brand new complex tech. And the regulatory environment is always evolving.
And broader market risks?
Sure. Sensitivity to shifts in sentiment towards growth and tech stocks. And just macroeconomic stuff. If there's a downturn, IT budgets often get squeezed first.
The sources also specifically flagged potential impacts from U.S. tariffs of 2025. How could that possibly affect a UK software company? Seems odd.
It does seem indirect, but the sources address it. The main point is the direct impact is likely minimal, maybe zero. These tariffs target physical goods imports, like from China, steel, cars. Arqit sells software and services from the UK.
So no tariffs on their product itself.
Right. But the sources raise potential indirect effects. If Arqit's customers, especially in manufacturing or global trade sectors, hit by tariffs, face higher costs or disruptions, what happens?
Their budgets might get tighter, less money for cutting-edge cybersecurity projects.
Exactly. It could slow down adoption. And if trade tensions contribute to a wider economic slowdown, that could dampen investment in advanced tech globally. There's also a tiny risk mentioned about hardware costs if they or customers use tariff-affected components, but that seems minor for Arqway.
So tariffs aren't a direct hit, but more like a potential background economic drag that could hurt customer spending.
That seems to be the assessment from the sources. Okay, let's try to pull all of this together now. Through that specific value investing lens you asked about, where does Arqit stand based only on this material?
Qualitatively.
Qualitatively, yeah, they're in a massive potential market, tackling a real future threat. But they're very early stage. The business model isn't proven at scale. Execution risk is sky high. Competition is fierce.
And quantitatively, the numbers.
Forget traditional value metrics like DCF or PE. They're useless here. No profits, barely any revenue. The valuation, that price to sales around 1,400, that's pure speculation on the future. Zero basis in current reality, according to these sources. From a value perspective, it looks significantly overvalued. There's no margin of safety evident in the current price based on this data.
Do they have a competitive moat, a sustainable advantage?
Well, the sources mention possibilities, the tech, patent standards that amplify IP.
Yeah.
But honestly, with so much competition and rapid change, it's just too early to say if they have anything truly durable yet. It's uncertain at this stage.
The sources laid out a bull case and a bear case.
Yep, bull case. Quantum threat hits hard and fast. Companies rush to adopt PQC. Arqit's tech wins out, maybe becomes a standard. They execute brilliantly, turn that pipeline into huge recurring revenue, become profitable, generate cash. The dream scenario.
And the bear case.
They fail to convert the pipeline. Deals stay small or keep getting delayed. The cash burn continues, forcing more and more dilution. Competitors eat their lunch. Or maybe the quantum threat takes longer to materialize or other solutions become preferred. Basically, the potential never turns into reality.
So how does this align with classic Buffett-style value investing principles, based only on this material?
The misalignments are pretty clear, according to the sources. Understandable business. The tech is complex. Maybe tough for a generalist. Favorable long-term prospects. For the industry, maybe. For Arqit specifically. Highly uncertain, high risk. Able and trustworthy management. New team, relevant background, but unproven execution. And that lack of insider buying really stands out as a potential negative signal on conviction.
But the biggest mismatch.
Attractive price. Absolutely not, according to these sources and metrics. The valuation is pure speculation. No margin of safety whatsoever based on current fundamentals.
So let's circle back and answer that opening question directly. Based on the sources you provided, is Arqit a value investment right now?
The clear conclusion from this material is no. It's a bet on future potential, on market sentiment, on hope. It is not supported by current financial reality or traditional value principles.
It's firmly in the speculation category. High risk, potential for high reward, but speculation nonetheless.
That's the assessment based on the data provided.
Okay, here's a final thought for you, the listener, to chew on based on all this. We see this huge gap between the market's apparent excitement for Arqit and its actual current financial state and risks. What does that tell you about how these kinds of early-stage frontier tech companies are valued today? And maybe more importantly, what level of risk, betting on future potential versus present performance, are you comfortable with? Really appreciate you joining us for this deep dive. If it was useful and you want us to tackle a stock you're interested in, please do like and subscribe to the Stock Analytics AI YouTube channel.
And remember that Euro 4.99 month membership gets your ticker prioritized plus earnings analysis. It's a good deal.
All right, just the standard disclaimer to wrap up.
Right. Based only on the source material provided for this deep dive. This report is purely informational. It's not financial advice, not an offer to buy or sell anything. Always consult a qualified financial advisor and do your own thorough research before making any investment decisions.
And this was generated by an AI using only the research material provided, dated June 5, 2025.
Correct. While the AI aims for accuracy based on that data, it can't guarantee everything is perfectly correct, complete, or up to the minute. Markets change fast. Company situations change fast. So please do your own homework, verify everything. The analysis here is based solely on interpreting those specific research snippets. Real-world data might be different, and new info could have come out since.
Essential points. Thanks again for tuning in. We'll see you on the next deep dive.